Hey everybody, this is Craig Moser. Hope you're doing well. It is the 9th day of August. Man, what happened to this year is it has blown by. Wanted to do a brief market brief, and talk to you a little bit. It has been the wild, wild west here so far. The world is crazy, as best I can say. Wanted to look at a few things and give you our view and concerns, reading research. So I read, obviously, in my business, a lot of research, and it depends on what the slant is from people as to what they're trying to say is going to happen. Here's the first thing I'll tell you. Nobody has a clue what's going to happen. They don't. They're using some sort of analog type of thing. They're looking at information. They're trying to make sort of assumptions. This happened in the past, so guess what? This should happen in the future. The dynamics are a little different this time. We have a lot more money in our economic system. I'm not going to beat this drum to death, but we've printed a lot of money since 2008. So there's a lot of extra green cash out there. We've also created a lot of debt. We had a lot of debt in World War II as well, a lot of it, because the government needed it for tanks and soldiers and planes and all that other stuff. So it's not unprecedented that we've carried this much debt per GDP, but we have a lot. And so the dynamics of what's going on, a little hard to see using history, what would be the best thing to look at. So I'm going to just pull off of one of the research pieces that I did today before here, if I can find it. And it was from Vanguard. And Vanguard was doing a 10-year projection. Are they right? No clue. I don't know if they know. But the returns are very low for a lot of the things that we've made a lot of money on in the past, like large cap growth type things. Pretty low over a 10-year projection, with a whole lot of sorry about that, with a whole lot of volatility around the average, which makes it kind of tough if you're an investor, because if you're looking at something that has a good pattern like this right here, this is kind of what you want, upward sloping to the right. When it does this other thing with the other side of this, that means that we lost what we made. So having strategies in place that not only are in things that appreciate, but also generate income. So what would that be? That would be a dividend. That would be some sort of structured note type strategy. That would be perhaps real estate with income in it. Things that actually pay us, that we can actually use the money. Those are things that we might need to have some conversations about as we're moving into the future. Only because the future, at least according to what I see at Vanguard, is pretty low returns over the next 10 years with higher volatility. And you can kind of see that that's happening. Here's the S&P 500, which is the one I always start with, the Standard & Poor's 500. So it's 500-ish, not exactly 500, but a little more than 500 companies. Representation of that would be NVIDIA and Bank of America and Tesla, Disney and Exxon. It's a big index full of amazing companies. It's weighted heavily to the biggest companies, about 25%-ish of that index is in, Microsoft, Apple, Facebook, the name, or Meta, whatever we're calling it today. But those guys have the market weight heaviness in the S&P. So when we look at this index, we see a good run up. Okay. People were able to buy the dips, buy the dip, buy the dip, buy the dip, which is a strategy that worked in a growing economy or an economy that has a lot of money in it. And now when you see a market cap, and it coincided almost point blank to the first of the year for the S&P. And then we started having these sell-offs. And so the people that bought the dip, perhaps they made a little bit, but they made less than where the last high was. Opposite of this, less than the last high. Okay, now we've hit this one. This is a good one. So when we look at this, just understand that what's happening here is we're seeing lower highs, and lower lows. So be cognizant of the fact that when we have a rally like this, depending on what you believe, that might be a bear market rally. I'm not saying it is, but it kind of acts and smells a little bit like one, so maybe it is. Who knows? When you look at this, you can kind of see, not perfect, but daggum, it looks pretty close on a declining scale, just like this looks like an appreciating one. All right, so off of the S&P, that's a good representation of United States. So we're not in an upward trend regardless of what anybody says. All right, if we look, for example, at Europe. Now this index is Europe, Australia, and the Far East. That means developed countries like Japan, Germany, France, England, Australia, Canada these guys fit into this thing. And so what you're seeing again is a similar story. We had rallies coming off of 2020, a double top here, triple top here, and then the market has not been able to sustain an upward trend since then. So what that should tell you is we're correcting at some point. I don't think this group of countries is as strong as the US. I just don't. So what they're doing from an economic standpoint may be more difficult for them to create upward trends unless we're in the game with them. All right. The emerging markets, and I do this one, IEMG. I just use the iShare version because it's easy and I can remember the symbol. There's several of these that have this same set of components in them. And the easy way to say is Russia, India, China are the big three in this index. And the same thing's happening here. We've had a decline somewhere around 28 to 30% over the past, well, I think we're back here to 2021 in February. So we really haven't had an upward trend in over a year and a half. And so that's just kind of telling you that the world at large is not accelerating, and the stock prices are giving you the understanding that people are selling some of these stocks and there's some reversion to the mean, which just means that there's an average price, and we're going closer to that. Let's see if I can show you a little bit more. So here's a 5-year chart of emerging markets. And so we're here right now. 5 years ago, that index was there. So if you had no mechanism in place to sell here, then you're just riding this pony up and down, and it really is not giving you any revenue that you can keep. You have to make some decisions to sell. You can't just be a passive investor in something like this and expect to have a really great outcome all the time. Same thing with the European markets, not so much the US, I will tell you that. So Europe, Australia, and the Far East looks very similar. Over here was 5 years ago, and we're almost spot on the dime where we were 5 years ago. So sometimes it goes up, sometimes it goes down. You need to have some sort of mechanism in place that says, I'm going to sell somewhere up here somewhere, and I'm going to buy somewhere in here so that you can more beneficially get the trend that's benefiting you, rather than just saying, I'm going to stay in this thing all the time. I'll go back to the S&P for a second. A little better trend. So the argument here would be I could have stayed in this and it would have given me a much better ride, albeit plenty of volatility. There was also plenty of volatility on the upside. So as you're looking at the world, so far the US is still giving us the best ride, although this last year hadn't been that great. All right, let's look a little bit at oil. So this is not the price of oil. I think today oil is in the 90s somewhere, and oil rushed up this past year, double topped right in here. And currently it's starting to sell off some. So I don't know exactly what the dynamic here. It's not all a supply and demand market, meaning that oil, to a large extent, OPEC determines this price. The Saudis, the Russians, people in that organization of petroleum exporting countries, OPEC, they determine to a large extent what we pay for a barrel of oil, which translates to what we pay at the pump. Right now, it's off of those nosebleed highs that we saw back in June, which were pretty rough. I mean, if you remember back, we were seeing oil prices, gas prices that we'd never seen before. It has tailed off some, but by no means is this low. I mean, here's a 5-year look at the price of oil, not the actual oil price, just the charting. And this is something that you could actually buy to get the futures. But you can see oil prices went way down in 2020 and have skyrocketed since then. So that's what happened. That's history. Things that people are asking me about, so I put some of that in here. This is not plywood, but this is a lot of the companies that are in the wood business. And you can see again, COVID, wood prices got stupid crazy high, and that was sort of a spike in May of last year. And since then, the price is starting to normalize some. I'm not saying that it's cheap. I went and bought plywood. It kind of was in sticker shock. It really hasn't come down that much, but lower than it has been given a year and a half ago, somewhere in that range. So just understand this commodity, I would expect the supply chain is starting to open up some, so it looks a little better than it has. Everybody asks about gold, so we'll look at gold. Should I be buying gold? And I'm like, gold ran up. This was the bottom on it in 2018, and it ran up and spiked right here. And that spike was, guess when? 8/5/2020, and since then it has been a pretty dicey looking pattern for a chart. Here's 2 years, so you can see over the last 2 years, gold is lower than where it has been in the last 2 years, with a couple of spikes. Right here was one of them, pretty good one actually, back around March of this year. So no definable pattern that says, okay, everybody needs to pile into gold because of end of world or something. But if you want some, try to buy on these dips, and just be cognizant of the fact that a yellow piece of metal may or may not save you if things are bad. All right, what else do we have in the list here? I put copper in here because copper I call a canary in the coal mine. When we look at copper, one of the things that we're thinking about is business building something? Are people putting copper lines in their house for water? Are companies building things that require that? So copper ran up over the last 2 years, has stayed up fairly high, and now has started to drop some. That's a 30-some% drop. You can see that the price of the copper, at least using the United States Copper Index Fund, has gone down from where it was at the first part of the year. So something to pay attention to. And if you look at real estate, now this is not home prices necessarily. This is just a real estate index that Fidelity runs, and I remember the symbol. So again, real estate sort of spiked out right until the first of the year, and now we're seeing some declines. Still high. Don't kid yourself, still high. And regionally over here, it seems like we're getting a lot of people moving in from different parts of the country. And so you might see this part of North Carolina, especially, still having strong demand. So that's a good thing. Don't know. But nonetheless, when you see it, the price of real estate, at least using this index, has declined some from this spike right here, which was January. So just take that for what it's worth, real estate. So as we look through the world today, nothing really stands out as, hey, there's the leader and the upside. So be careful out there, I guess is the way to say it. Understand that just because we have rallies like this tech rally right here, it doesn't mean that this is the end of the market and we have seen a bottom. It might, but I don't know that that's the case. Again, lower highs is what I see. So be aware, buy good quality things, have your shopping list if you're buying for yourself, and make sure you understand what you own. If you don't understand what it is, do not buy it. And last thing, I got to do the bond market, so I'll do the bond aggregate and leave that alone. Nothing good from a bond price happening other than it looks like we may be leveling off here. So I've heard some people say that, maybe the Fed's not going to be as aggressive going forward. I think they will. We'll see who wins. But you might see the price of these bonds go down a little further simply because they're raising interest rates. And right now, at least on this iShare Core US Aggregate Bond ETF, the current yield is 2.14. You're not going to get rich on this. It's just up from where it was a year ago quite a bit because the prices were higher back then. All right, I'm going to let you go. Appreciate your time and hope you got something from this. If you need us, feel free to give us a call at 336-448-1086. Can go over some things with you, have plenty of analytical skills here. And if you need some financial planning help, planning for retirement, planning for, looking at business type things, doing 401ks, we do those things for our clients. Along with the estate planning and working with your tax professionals. So again, give us a call if you need us, 336-448-1086, or look at maestrowealth.com. That's our website. Make it a great rest of the month.